It's the 9th of July 2026, 9:30 a.m. CET and 3:30 p.m. Manila time. This episode talks about China considering restrictions on overseas access of advanced AI systems, S&P also threatening a downgrade for Indonesian stocks, the UK's outlook under a potential Burnham premiership, and the IMF's rate hike and cut call for the US Fed.
Hello to our listeners. I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgreen, the founding CEO of Lundgreen's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundgreen's Investor Insights. Join us as we analyze developments in major economies and financial markets globally.
Hi, Peter, and hello to our audience. How are you? What's been keeping you occupied this week, Peter?
I'm good. Busy, particularly busy with new investors coming into the new Danish defense company that our fund,
Mhm.
has spinned off together with our cooperation partner, Normark Defense. So that is extremely interesting. And then we have, still sort of ahead of the summer break, busyness of all kind of things. Good days, actually. And what about you, Mel? How's the week been so far?
Well, apart from trying to take a mini vacation, of course, the work does not stop. A lot of moving parts in Asia and the West as well. We are always on the lookout in the markets, and we have some pockets that we'd like to explore.
Yeah.
Let me start in Asia, of course, my home base, so to speak, and in China. There is some sort of an Uno reverse card going to be played against the world. Um, there are reports now that China is planning to ban overseas or foreign access to their top tier AI models in the
Mm.
near future. It is said that they're already in talks with the big tech companies in China like Alibaba, ByteDance, and basically any other major AI model developer since
Mhm.
June. And what they're trying to do is to secure access to this homegrown AI technology. So they're saying it's kind of a national asset, a national cybersecurity ace, so to speak. And they wanted to essentially do the what the US did in 2023. In 2023, Biden had banned the export of the top grade supercomputer chips or computer
Mhm.
chips
Yeah.
to the rest of the world, particularly China, targeting China. And now China wants to do the same. They're saying that like it's a concern towards protecting I guess intellectual property and
Mm.
cybersecurity. So the likes of DeepSeek and whatever future models that these big tech in China develop, it would be for access in the mainland only. So it's kind of an emerging trend, so to speak. Um,
Mhm.
in the US, even the Pentagon has done this with like Claude and Anthropic. Um,
Yeah.
Mythos is like a very specific or very sensitive system right now about who can access them. And yeah, it's looking like I'm not gonna like fuel the fire, but it's looking like an AI warfare. Like they
Yeah.
know just how powerful the models can get. First it was hardware that they're fighting over. Now it's also the software, and it is the future, which is why they're trying so hard to like contain it. But at the same time, of course, that is counter global trade and global, I guess, development because essentially that's how you innovate, right? You take existing models, you see how you can build on them.
Yeah.
But this is a bit different. Earlier on in May, China already restricted or like required clearances for the heads of like AI software development companies when they travel abroad. So it's basically I guess preventing like a brain drain or like the transfer of knowledge, which is kind of odd to hear in the
Mm.
21st century. But yeah, it's looking very much like this is really the frontier, the new arena at which major economic powers are battling over. And of course, that is different from the whole AI boom in the stock market. And yeah, the systems are very interesting. And for like normal consumers, regular consumers, it's only what we know is only the chatbots that you can talk to and it can respond to you. But this one is a whole new level that I don't personally I can't begin to grasp how complex and how thorough the systems are in terms of like running government systems. So um it's something definitely worth watching out. And the rules, knowing how the Chinese government operates, it's likely to come out very soon. And yeah, resistance isn't really much of a thing there, so it is likely to happen, and it is likely to happen in the maybe in the next couple of weeks.
Yeah, this is highly interesting. As we are talking about a high stake game. Yeah, as as you say, it is one of the largest countries in the world that is now realizing how they want to play the AI
Hmm.
game and how, as you also say, how powerful AI can be or is. And it's from a country where there is among the top two leads within
Hmm.
AI, depending on how I would say how we judge and how we measure. In some areas, US is ahead, and that is particularly on the AI chip
Yeah.
production. They're like 3 to 6 months ahead in development all the time. But there are other, how to say it, AI systems, AI computing, where China is very much, very far, and also longer than the US is. It'll be a battle between the two giants, basically.
As always, yeah.
Yeah. The key is you could say, okay, hey, if you're an investor in one of the so in AI companies or a company, the Chinese tech companies that are strong within AI, you'll say, wow, they own something that is really gold. It is so much worse that the Chinese government is trying to uh,
Yeah.
protect it. Yeah, and we have seen even U.S. Top C level as a CEOs,
Hmm.
executives visiting China the past 6 months and being shocked about how far China is in
Yeah.
utilizing AI in all kind of ways. So it's we're talking about it is a top player in the game, China.
Definitely.
Um, and you say, yep, then we have as investor we have maybe shares in some of these companies, and they are owning gold, and that is actually true.
Hmm.
But the key is if they if they are restricted for exporting
The
the
technology, yeah.
software technology to rest of the world, is that actually positive for these companies? And it's not necessarily the case. The other way around is that if the Chinese government is protecting them so extremely well, they will have probably a sort of exclusivity to the Chinese market that is booming. So it's a two-way thing that we'll need
Yeah.
to study a bit closer. But it is actually a high stake gamble
Yeah.
that observing right now, and as you're pointing at, it's extremely interesting. There's another AI war coming up, and it's developing extremely fast. We should just that investors say maybe when they're lying at the beach and need something to read in, find a couple of articles or whatever. Yeah, that could be as exciting as the best the best book you can find.
Maybe they can try talking to the chatbots as well to
Yeah,
tell
that
them
was,
more.
of
Yeah.
course, something. Yeah, extremely interesting, Mel, for sure.
Yeah.
Summer crime, yeah.
Let's jump to a neighboring Asian country, and it's Indonesia. We haven't really been the kindest towards the Indonesian markets recently, but for good reason. We do have something out of that whole stock market stock frying issue. Now there's another party that we see is raising red flags over Indonesia.
Yeah, it sort of continues. What we would say the bad news for the Indonesian stock markets, or the vibes surrounding the Indonesian capital market, whatever we want to say. But now, after MSCI really have raised extreme concerns about the
Mm-hmm.
stock market and want to consider to downgrade it from emerging market status to frontier market. Um, Actually, another big similar player, and that is the S&P Dow Jones indices. They have been out now warning about the same, that
Mm-hmm.
Indonesia is risking to become a frontier market, and that is it's on the watch list, and it will be reviewed again in 2027. On the other side, Indonesia has a chance to,
Make it right.
yeah, try to turn around the situation, yeah, and improve some of the critical things that is pointed out in when we talk about Chinese stock market, and that is particular very huge companies being listed, but without any true pricing or flow or
Yeah.
turnover. And the same companies actually have a heavy weight in the indices, and that means that you have inefficient individual companies pricing also spilling over in important indices that also have a part of this inefficiency, pricing inefficiency in it. And that is, of course, not satisfactory for international investors.
Yes.
It should also not be satisfactory for Indonesian investors. That's, of course, the other story. So and it's very much up to the Indonesian authorities to say they want a much more clean and transparent stock market, which is the need if they want to grow the capital market in Indonesia. And we are talking about a very big economy in
In
Southeast Asia.
Southeast Asia.
So it's very important. And there is only one thing to do is to say, get it done.
Mm-hmm.
Uh, because otherwise it will be a disaster, and it will really hurt the economy. So this is but we have, as you said, we have sort of touched base on the story several times. But it is, when we talk about Southeast Asia, it is a very important thing that is going on, and
Yes.
that was just sort of the latest news on on the development. We shouldn't focus more on that, but
Mm-hmm.
important.
Yeah, at the time when the global markets are kind of struggling with the US Iran conflict, it's of course favorable for any economy to fortify whatever domestic base they have. In Indonesia's case, if you wanna attract more capital to your market, you should be setting things straight, especially if you have a potentially high growth, um, high consumer base economy, because it's such a wasted opportunity to like get the flows to your country if you don't uh, set up things correctly, or at least make corrective measures to keep the money or attract more investment flows to your country. So yeah, that's really why we're watching out for this. But until it gets resolved, we do share the same concerns as the MSCI and S&P indices are saying.
Yeah.
But anyway, we can cross over to Europe now and talk about the UK economy. So a lot
Mm.
of things going on in the British economy, and the biggest ones that's being closely watched is who will be the next prime minister. So after Starmer resigned last June, now there are discussions that longtime Manchester leader Andy Burnham is headed for 10 Downing Street. Maybe in a week or two. That's the discussion. And there's this thing that apparently he got famous for, kind of, I think it's also some branding going on here, like it's called Manchesterism, or like business friendly socialism. I'm
Mm.
not sure if that's really a thing that you could describe here, but yeah, apparently Burnham is known for leading Manchester uh to secure faster growth than London or the rest of the
mm,
UK economy. So they were looking at 3% GDP growth when the rest or the whole economy of the UK was growing at like 1.5%. So yeah, that definitely looks favorable for his odds to
mm,
secure the leadership, and popularity, of course, is also likely. But he has some bold and populist measures that he has announced in the past few days. He's saying he wants to rebalance the London centric governance and kind of
mm,
devolve more functions to the individual cities and areas, regions in the UK. He also wants to fund more social housing units. He also wants to do welfare reforms, expand benefits, possibly raise the threshold that exempts people from paying personal income taxes while not raising the value added tax, which is already at 20%. So it is, of course, nice on paper, but it's every politician's strategy to, promise uh, the moon and the stars. But the context really here is that all of these will cost money, and the UK doesn't really have a lot to spare in terms of its fiscal position.
mm,
Just the other day, the Office for Budget Responsibility has actually raised a serious red flag about the UK's public debt position. Um, at 95% debt to GDP ratio, it's already, of course, uncomfortable, but it's not unusual to hear a developed economy with that debt burden. But the warning here is that if the status quo is maintained, or even a bit of additional benefits are granted without the corresponding fundraising measures, the UK is looking at a 300% debt to GDP ratio by the 2070s, or like 50 years ahead.
mm,
So it's likely the base scenario right now because the population is aging and
mm,
more leakages, as well as more people availing of benefits. So it's not unlikely that it would really reach this level unless drastic fiscal tightening is done. We've always been wary of very high debt ratios for governments, especially for the economies that we cover. And the UK is definitely one of them. It is a growth killer if you try to manage the debt by reducing public spending, but also a growth killer if you raise more taxes just to afford stuff for the government. So all scenarios are pointing to this ever rising debt path, and
mm,
there's no room right now for the planned reforms, however needed they are, especially if it means more government spending. So I think we go back to our mega trend about productivity. So it's really, now that you can't move a lot in terms of money, in
mm,
terms of raising more taxes, the focus should be raising productivity. That
mm,
way, people can earn better to afford what they want and need every day.
mm.
And yeah, that's been our call ever since for many European economies. And the UK is no exception. And I guess more efficiency and better labor productivity would kind of soften the blow as far as debt is concerned.
All in all, interesting development. Also, the political game around the prime minister position in UK, what has happened. But as you say, it's what an uphill position to take over. And if we just play a bit around with the long term numbers that you mentioned, looking into 2070, it's an extreme debt level.
Yes.
And also when we take into consideration what you mentioned, that the population will decrease. So it means that government debt per person,
Mhm.
it will increase into an insane amount. And we are looking into situations where people will not be allowed to leave the country anymore, because you need to pay in your government debt. Yeah, in the end, there will be almost no people, and they will end up carrying billions of debt. Yeah. So it is extreme thinking, the extreme situation, and our intuition would say then it won't happen because it is everybody would say no. As all financial markets, everybody will step out. Yeah. So that is a long-term disaster. UK
Mm-hmm.
is moving towards. After all, when we're talking about UK, a small positive sort of assessment of UK compared at least to the continent, to the European continent,
Yes.
and that is that the UK economy is, after all, still a bit more flexible. Also, when we're talking about doing business, uh, and for companies, it is the life is more flexible. Simply running a company, having a company, whatever, it is
Yeah.
more flexible than the continent, and they have a small lead and an advantage, and that is also why UK can generate some GDP growth where the continent is struggling, yeah, particularly Germany and France. Now, but that is so when we have sort of taken that small of sunshine, that is
Mm-hmm.
basically all what we have left, yeah. And if we turn back to the probably coming prime minister, and he's an interesting character, yeah.
Yeah.
And if we look at his resume, yeah, a long time standing
Yeah.
mayor for the whole metropolitan Manchester area. And Manchester is, of course, not just a city in UK; it's number two. So it's not a small thing, yeah.
Mm-hmm.
But it is still a city or a metropolitan area. So the things he has fixed is partially in competition with other cities or metropolitan areas in UK. Uh, closest competitor is Liverpool. Yeah. So that is somewhat different than running the whole country.
Mm-hmm. Yeah,
And
definitely.
yeah, and so he is very fine and well done, fixed the local transportation. As the buses are now running, and they're actually driving to destinations in Manchester where people would like them to go. And that it's it's it seems a bit of a laugh, yeah, but it's actually the situation in big part of Europe.
Mm-hmm.
Basically a lot doesn't run, yeah, and if it works, then it is actually still not to the satisfactory of the users in big time. So all these things he has fixed and he's done, and that's good. But running a country is just so much different. And he will, despite the sort of ideas he has, he would lean very much towards Labour's economic paper that they're using today, and it won't change a lot. That is our assessment, and it's a bit sorry, but it won't really move UK's economy into an optimistic boom. It's not how we see it. So from the macro perspective, if we look into the stock market and say, okay, how much does the macro factors mean for a stock market? Yeah, they mean something. It's not the most important. Most important is, of course, how how the companies are doing individually.
Mm-hmm.
But there won't be any positive impulse. So it's not reason no reason to rush into and buy stocks on that one. And as you mentioned, when it comes to the European situation, the internal European competition between countries will be on productivity, and there is only one way to change productivity, and that is to increase the working weeks, the number of hours people they work. So when that competition really takes off, Greece are absolutely in the lead. Everybody knows it's our favorite, but that would be the thing. Yeah. So we think it's interesting what's going on in UK because the story around the PM is fantastic, interesting, but we're not really optimistic when it comes to sort of from an investor perspective. So we will see if we can find some sunshine somewhere else. Anyway, yeah. Well,
Let's take a more global approach this time. Kind of like zoom out a bit and see. We have come across this recent report from the International Monetary Fund regarding inflation and how central banks will respond. Here goes the IMF again, doing our job a bit. So yeah.
Yeah, the other day they came out with, should we call it a warning? We don't know, but at least a new assessment. They are warning about higher global inflation, um, and actually also lower global growth. And this year it's dropping from 3.5 to 3% global growth. That we don't like, and that we actually notice. We agree very much on that one. Um, and uh, where they hang their hat on global inflation and the growth on the high inflation is based on the conflict between US and Iran. And not only oil, energy, but also it generates some bottlenecks. And when we're talking about uh, all kind of goods and again the global supply chain and so we do not
Mhm.
disagree. But if that is the main scenario and the main case, we still argue things will settle, and it's not our biggest concern. If again, as we mentioned several times, if we start to see second round effects on the inflation globally or per, per country, we'll be a bit more worried. But it's not what we're seeing. So we see it coming down again,
Mhm.
but because we have so many economic weak countries in the world, and that is particular the old countries, it is particular Europe, but also partially US actually, then every time there is a hit, it doesn't, these countries do not recover. So the growth hit is is a bit more staying. That we don't like. And then the IMF is speculating a bit on how Fed will act. Okay, the Fed 1 or 2 days ago came up with a minute indicating that they are leaning towards a hike, particularly if the inflation level sort of stays where it is. So it is also what is priced in the market. Actually, now
Yes.
it's priced in the market that Fed hike in October with a 0.25%. Now, that is also following what IMF thinks. But IMF thinks, argue that Fed will lower again next year due to, again, low inflation. That is a bit unusual. Normally, Fed will not make a bump. They will their rate hike cycles are lowering are very long. So if Fed in October would expect themselves to cut again in the new year, they will not hike in October. That's our argument.
Yeah, that's a very short lag time.
Yeah.
If you're bound to cut anyway, maybe just wait it out, right?
So what could make them not to hike in October? Yeah, much lower inflation rate or concern about growth, economic growth in US. And that is a possibility. Now, but if they hike, they will stay where they are also in 2027, or they might hike once again.
Mhm.
And this is sort of okay. Currently we join this majority scenario, saying okay, there'll be hike. It's priced in the markets, but when it comes, it will make jitter and it will pressure a bit, and it'll also lead to more volatility. And that is also even now what we see when we're looking into 2027. Um, Again, sort of these volatility engines that also hikes from the central banks, particularly when we talk about stock market. So this is so we are partially sharing the view, but we don't share the view that Fed will hike and then lower. That's not how it works.
Yeah.
So yeah, good. But what we're talking about is not a shock scenario. We're not so afraid.
Mhm.
So we're still okay actually.
Yeah. We still very much see that the risks towards the US-Iran conflict will recede, although it has been very volatile with Trump again saying that the truce may be over. So yeah, of course, immediate knee-jerk reaction was the that oil prices are up again. I saw a 2-week high as most recently. So but that could easily come down just as fast as it shot up if negotiations are back on the table. So we continue to watch out for that. But for now, as we always round off this podcast, we look at the global outlook that we have and any risks that we see ahead. Um, Let me start with my region.
Mm.
For Asia, it's really more upbeat. Of course, the oil shock and the whole geopolitical conflict is causing some jitters as far as markets are concerned, but growth will occur like much faster than the European and the US counterparts. Just very recently, the World Bank raised several economies into upper middle income status, including the likes of the Philippines, and Sri Lanka and Vietnam, so much, to join our colleagues like Thailand, Indonesia from way back. So the growth is really here, and higher incomes, household incomes will continue to fuel consumption and overall growth, while the rest of the developed economies continue to find or to struggle with finding growth triggers, with productivity still not at the level that we like, Peter.
General, we are okay with the world. It could be a lot better. It could
Mm-hmm.
also be a lot worse. We still like risk, and we still like emerging markets. We still like overweights in stocks in many areas. We like the European private equity market, but we are in a shorter end when we talk about duration in the bond market, but we still like the credit risk, particularly again emerging market credit risk. So, and that is an indication of we are not afraid of the world. We try to point at the opportunities and say it's where it's going forward. It's not that we haven't noticed what's going on in Germany, but we didn't choose to cover it today. Some reform work is going on. We see we now have a getting closer to a European summer break. It calms the markets a bit, or at least makes markets a bit slower. Doesn't have to calm down the volatility. But we do not think that the German reform work and what has been so far suggested and approved will generate any particular upside to the German economy. We're sorry to be so realistic about Germany, but it is simply
Mm-hmm.
not. Is far from what is needed, and that is actually why we haven't had it on the plate today. It will not move the German or the European stock markets further up. It doesn't change our view on Europe versus the rest of the world. We still believe more in the rest of the world. So we actually stay unchanged simply and do see some sunshine. Yeah.
That's all we have for this week's episode. We'll be back next week. Thank you, Peter, and thank you to our listeners.
Yes, thank you.
Thank you for tuning in. As always, we keep a watchful eye on market shakers and movers. Catch the next episode of Sound Economies with Mel and Peter, a podcast by Lundgreen's Investor Insights. Available on Spotify, YouTube, and wherever you listen to podcasts.
Lundgreen's Invest has secured a historic quadruple exit for its high-tech defense fund. Following the sale of 4 investments to the Danish defense company Omni Capabilities, the fund's value jumped by as much as 40% in just one day. The good news? This evergreen fund is officially open to new investors with an exit possibility every 6 months. Visit lundgreensinvest.com to know more about this co-investment opportunity.
Lundgreen's Capital has been in the business of investment advisory and wealth management for over a decade, with our high-performing and multi-awarded funds to show for it. We're taking this to the next level through an IPO in 2 years. Join us in this journey. Visit our website to learn more.